Hello everybody, I'm back officially, and today we're going to be doing a Microcap Mania video. Basically, I went on vacation for a week. It was very nice. It was good to take a break from working an internship, school, and then also trying to pump out videos weekly. It was nice to take a break for a week. Now, granted, while on this week of break, I did actually end up investing some in our Microcap Mania portfolio. Basically, I had a lot of time to kind of think over some ideas and some companies I already had on the watch list, and really kind of the theme of this was I wanted to try and add some dividend paying positions to the portfolio. Now, typically when it comes to dividends, I'm not necessarily the biggest fan. I think if your number one priority in investing does boil down to income and income at that certain time, there are a lot of opportunities that you're better off simply investing in bond funds for the most part. A lot of the companies that you see with these outrageously large and high dividend yields are going to not really see that much price appreciation, or they might actually have it structured in a way that they're really going to underperform in the future, as they're really just trying to prioritize this high dividend yield to attract investors. And so typically I'm a little bit of the skeptical side of dividends, and I've already kind of touched on it in videos prior to this one. And so I kind of wanted to use some of the ideas I had brought up earlier and kind of pitch it into our portfolio so that I could prioritize adding some sustainable dividends and some companies that still have some growth opportunities. It's not just beaten dogs that are looking for a way to somehow attract investors, so they're just taking all of their money and funneling it to Vanguard and BlackRock. These are actually companies that have it so that maybe their payout ratio, instead of being something ridiculous, I mean, a lot of times you'll even see over 100%, and sometimes in the most extreme circumstances, debt finance dividends, which I absolutely hate with everything in my heart and soul. But instead, I wanted to try and prioritize finding companies that maybe paid around the 20%, 30% payout ratio, and then they still offered dividends, but they had enough cash on their balance sheet, they didn't have a lot of liabilities, and overall the dividend doesn't just become a commitment they're forced to do so that their share price doesn't tank off a cliff and kill the company. Instead, the dividend is something that they can use a bit to kind of reward shareholders for holding their stock while they still kind of do good things and kind of look to reinvest in the company and grow the company and do R&D and things of that nature. So the three names I ended up investing in were already on the watch list. One of them actually came from the Turtle Beach video. I was looking at it. I had mentioned in that video that I was kind of down between these two, and then I was kind of still paying attention to it, because just because I didn't pick it at that time doesn't mean that it wouldn't ever have a spot, and I saw it for a good price valuation. And again, a lot of these are going to be very much in the strength of asymmetric bets, where the company trades at such cheap levels, it's significantly below sales, and the cash on their balance sheet is sometimes larger than their market cap, just ridiculous, weird things you find occasionally. And overall, being in the microcap space, you're going to actually see those, whereas you never see something in a large cap where it's oh my goodness, it's trading at this much of a discount to everything and all the factors are made up, because there's so much focus already there. So overall, going to bring you those three names. We're going to get right into it. I just had to yap a little bit to kind of introduce the subject. So the first company I actually picked was Ranger Energy Services. Now, Ranger is a provider of onshore high-specification well service rigs, wireline services, and processing solutions. The company provides services that are needed for the flow of oil and natural gas throughout the productive life of the well. Basically, if there's a well that's getting put in or is already existing and they need help with it, Ranger is the company to call. Now, Ranger Energy Services offers well completion support, well workover and maintenance, and installation. And the company currently primarily operates in many of the oil and natural gas basins across specifically the United States of America. While U.S. rig completion did actually end up slowing down in 2024, the demand for Ranger's services haven't necessarily slowed at the same pace, which I think kind of shows the quality of the services that Ranger's able to provide. Now, the real growth opportunity really comes for the company in the high specification well service rigs, as Ranger has really shifted towards a production focus. That's been their largest growth segment, and kind of where the company and the executive team really sees opportunities and wants to pursue further growth in those areas. Now, a large part of my investment thesis in Ranger as a whole is that the company is completely overlooked. Again, energy the past few years hasn't necessarily been the most attractive industry. We're seeing oil prices tank. There's just a lot of factors that go into that. Again, the oil rig completion rate is something that's worth noting, where it's not really the most attractive, especially when you have things such as the AI boom, and all of tech is really where all of the people are kind of going. And I think at the end of the day that really what attracted me to this was just it was so cheap, like so cheap. It trades, the company does sales 2x more than its actual market cap. So the price to sales ratio is 0.49 if I remember from heart. It's building up a cash position on its balance sheet. Prior, it wasn't doing that necessarily. And it's also improving its margins, which was really the thing that was kind of holding the company back from exploding. Overall, it's in a great position to actually kind of capture some of these trends, and also it's completely overlooked now, so the stock's cheap, but this is definitely something that's going to probably be a 3 to 5 year thing. And of course, as I mentioned at the beginning of this video, this company pays a sustainable dividend that I think it will be able to continue to pay very, very easily. The next company I actually ended up adding, which I had already brought up in the Turtle Beach video, is Immersion Corporation. Now, Immersion Corporation basically focuses on all things haptic feedback. They design, create, and license products that all have haptic feedback in mind. Now, for those of you who hear that term and you don't necessarily know what haptic feedback is, if you've played a game before and you have your controller on vibrate, anytime you play like a shooting game or a driving game, the actual technology that kind of vibrates your controller, or maybe you do VR and you do stuff like that, that's going to be that like shaking technology is going to be the haptic feedback. And they also operate in education, and they also operate in automobiles. So it's not just purely a video game thing necessarily. But the company operates in two main segments. They operate in immersion and then the Barnes & Noble education. And the firm's products are able to be sold with a kind of white label, meaning that if a customer comes to it, let's say Barnes & Noble has an idea that it wants to implement an Immersion Corp product into an existing thing in their education segment, they're able to go to them and then kind of slap the Barnes & Noble label on it. So Immersion really is just trying to focus on being a good player and kind of good supplier to its customers. Now, trend-wise, Immersion Corporation stock has definitely done a bit of a dive since 2018. It saw a large bump in 2018, and then since then, again, kind of disappointed a little bit. I don't necessarily understand why people think that haptic feedback is going to be like an explosive growth thing necessarily. I get that around then was the time that like PS5 was being developed and all of that, and they're actually a supplier for PS5 and their products are in those controllers, and I understand that, but at the same time it's kind of going to be something where you're going to wait until like the release of new consoles or the release of new technology, or if like Oculus makes a new thing for their controllers, or in their cars it's going to come with like more release things. Like for instance, I know some cars have like the steering wheel will like buzz at you if you go over the lane line. There are going to be things like that, but they aren't just going to happen all at once every single year. It's going to be like a few years on and off, and they've been very, very consistent in sales wise since 2018. 2018 they saw a huge bump up to 100 million in revenue, and then since then it's kind of fallen back and been a normal kind of thing. Really, a lot of the value that kind of comes with an investment in Immersion Corporation is going to be how cheap it is and how much of a discount it really trades at. There aren't necessarily a lot of people that view this as a company that's going to necessarily explode in the next year or two, but there is definitely potential in haptic feedback. And then in terms of the companies I actually picked to add into our portfolio, this is up there with strongest balance sheet for sure. They have a lot of cash, and then also they have a lot of what falls into short-term investments in Barnes & Noble. And really they saw a bump up with, they had Barnes & Noble as in the Barnes & Noble education that had been spun off, but since then Barnes & Noble has kind of consolidated that back all into one thing. And so they did see kind of a bump with their investment specifically. But overall, I think Immersion Corp definitely has a balance sheet that allows them to be flexible, and if they see opportunities, they can actually take advantage of it. I mean, they have a wide variety in their portfolio of patented products. They have over 1,000 different patents for haptic feedback technology, and a lot of those don't expire for some time. So we're really going to be able to see Immersion Corporation. If any companies want to do anything with haptic feedback, they'll have to eventually go back through Immersion Corporation. So overall, I think that this is a very cheap dividend-paying company that pays a sustainable dividend and has a, of course, balance sheet that'll allow them to continue to pay that dividend, and also lots of flexibility. So multiple factors I really like to see there. Then we come to the final company that we added into the Microcap Mania portfolio, and that is going to be LifeVantage Corporation. LifeVantage Corporation engages in the identification, research, development, and sale of dietary supplements, nootropics, pre and probiotics, and skincare and healthcare products. Recently, where there's going to be a large amount of growth potential, LifeVantage just released its new GLP-1 weight loss products. Again, GLP-1 is a natural chemical that already occurs in our body, but basically it's kind of an alternative to some of the other weight loss drugs that are out there, and the pitch basically for that is that it's a lot more natural. And as they're already a company that's very well established in supplements and vitamins and things of that nature, I think there's going to be quite a bit of success with them transitioning into GLP-1. Now, surprisingly, I'm kind of in the minority of that thought processing outside of analysts. Outside of analysts, their share price since announcing their GLP-1 lineup of products has definitely gone down. And I kind of think that this is a little bit overdone. Yes, they're going to be competing with some of the absolute giants of the weight loss drugs category, but LifeVantage as a whole, I think they aren't necessarily trying to step too hard on like an Eli Lilly turf or anything of that nature. And so I think there will definitely be a position for them, and so there is growth opportunity there. And then other than that, they're very, very well respected in supplements. They do a large quantity in sales. Again, this is something that trades at a severe discount to its price to sales, and the price to earnings ratio is quite low as well. Balance sheet wise, this might have one of the weaker balance sheets out of the three. They've just kind of started the dividend approach, and so there isn't necessarily a ton of cash on their balance sheet yet, but the trend is definitely going upwards. And then also over the most recent quarters, they've done really, really well and had kind of explosive growth in a way, and just haven't necessarily been rewarded for that. And I think that's something that kind of comes around with microcaps and things that trade at that level, is there isn't always going to be a ton of eyes to kind of reward a company that should be rewarded for explosive growth in microcaps. So overall, those were the three companies that I did end up adding into the Microcap Mania portfolio. I think each of them has their own unique strengths, but some common themes are there are growth opportunities still. I'm not fully relying on a severely high dividend yield as my only form of kind of investment. There are growth opportunities in these companies, also all of them at very, very cheap valuations, which I think is really, really important if you're going to be getting a dividend company that maybe might prioritize growing the dividend. Is they need to be at a valuation where if they get much lower than that, it's an absolute steal and you should be pouring money into the company. So overall, I give these a very solid thumbs up as they go into our Microcap Mania portfolio. Again, thank you guys for being understanding in terms of me taking a vacation, and I'm excited to kind of get back to making more frequent videos and kind of seeing what comes from here. I've been having an absolute blast. I mean, even on vacation, I was thinking about video ideas and very excited to kind of come back and do more of this. So thank you very much for checking out today's video. I hope it was a little bit insightful into how I kind of think about dividend paying companies, and I'm not just yield chasing. I think that's very important if you are going to be investing in primarily dividend companies or even trying to round out your portfolio. I think chasing high yields often kind of goes south, and you end up with companies that are content with just absolutely doing nothing or having their share price kind of trend downwards, and they're just kind of looking to coast and exist. So hopefully at least some of the names that I just added into the portfolio will do well over time. I think at least we're kind of compensated if they don't necessarily do well. It might not be a great compensation, but considering that they're just as likely to perform either as good, better, worse than any other company we add in, it's nice to have a little bit of reassurance in the form of a dividend. So thank you very much for checking out today's video. I appreciate you.